Today, we'll talk about top 7 gold ETFs listed on the US Stock Exchange. These ETFs track the price of gold and are backed by physical gold. If you're watching this video, chances are you are interested in investing in gold through the ETF route rather than buying physical gold. Now, the advantage of gold ETFs is that they make it super simple and fast to buy and sell gold with just a few clicks. And compared to buying physical gold, ETFs can be cheaper because you don't have to pay premiums, transaction costs, and delivery fees, which can add up anywhere from 5 to 10% of the gold's trading price, also known as spot price. Additionally, storing physical gold involves cost and the risk of theft. So gold ETFs are cheaper and easier to invest. And in this video, we are going to dive into the 7 biggest gold ETFs. We'll compare their long-term returns, expense ratio, taxes, and the pros and cons of each ETF. Towards the end, I'll also share an interesting feature of one of the ETFs that lets you turn your ETF holdings into physical gold. My name is Kanak and welcome back to my channel. If you want to learn more about investing, then subscribe to my channel. And your support is what keeps the channel running. So show your support by liking the video and sharing your thoughts in the comment section below. As you can see on your screen, these are the top 7 largest gold ETFs listed on the US Stock Exchange. GLD has the largest gold assets of almost $58 billion, whereas OUNZ is the smallest among the top 7 with about $800 million in gold assets. All these 7 ETFs do the exact same thing, which means they track the spot price of gold, matching the price at which gold is currently trading in the market. Also, all of these 7 ETFs are backed by physical gold. However, the custodians holding gold for each of these 7 ETFs can either be the same or possibly differ. Custodians are the companies such as JP Morgan, HSBC Bank, and others that hold the physical gold for these ETFs in vaults across various locations such as London, Zurich, New York, and so on. Now, the biggest differentiator among these 7 ETFs is the expense ratio, which is the fees you will be paying to hold the ETF. And if you are a long-term gold ETF investor, you would want to pay the lowest amount of fees to reduce your cost of investing in gold. As you can see on your screen, at the time of recording this video, SPDR Gold MiniShares Trust with ticker symbol GLDM and iShares Gold Trust Micro ETF with ticker symbol IAUM have the lowest expense ratio of 0.1% and 0.09%, which means by investing $10,000 in GLDM, you will only pay an annual fee of $10, whereas by investing $10,000 in IAUM, you will only pay an annual fee of $9. But on the flip side, SPDR Gold shares with ticker symbol GLD has the highest expense ratio of 0.4%, which means by investing $10,000 in GLD, you will be paying $40 in annual fees. Now you might be wondering that both GLD and GLDM are exactly the same product and sold by the same company, State Street Global Advisor. Then why would someone pay a higher fee of 0.4% for GLD compared to 0.1% for GLDM? One of the key benefits of GLD is that it is more liquid, which simply means if you are a short-term trader in gold, then it is faster to sell or buy the GLD ETF. And the reason why GLD is more liquid is that it is bigger in size by almost 10 times than GLDM, which means a higher number of people trading GLD than GLDM. So GLD offers high liquidity to short-term traders. Now let us talk about long-term returns of these ETFs. Expense ratio is the most important driver of difference in long-term returns of these ETFs. The higher the expense ratio, the lower the long-term returns of the ETF. However, the difference in returns among these ETFs is only marginal. And as you can see on the screen, GLDM has the highest returns over a 5-year period, as it also has the lowest expense ratio. On the other hand, GLD has the lowest returns over a 5-year period, as it has the highest expense ratio. Now, if you are a long-term investor in gold who plans to invest in gold for a decade or more, then the expense ratio will be key deciding factor for you to pick the ETF. If you invest in GLD, then over a course of 10 years, it will cost you roughly about 4% of the average gold price. On the other hand, if you invest in GLDM, then over a course of 10 years, it will only cost you roughly about 1% of the average gold price. So that's a significant difference for a long-term investor. However, if you are more interested in short-term trading of gold, then liquidity becomes more important, and then GLD might be the right pick for you. Now let's talk about taxes on gold ETF. Tax rules change every year, and it can often be more nuanced for each individual case. So it is important to check the latest tax rules for your specific case. However, we will talk about the general tax rule at the time of recording this video. Gold ETFs are taxed at the same rate as physical gold, because ETFs backed by physical gold are considered the same as holding physical gold. At the time of recording this video, the long-term capital gains tax on gold ETFs is 28%, which means if you hold a gold ETF for more than 12 months and then sell your gold ETF for a profit, then your profit will be taxed at 28%. The long-term capital gains tax on gold ETF is higher compared to the long-term capital gains tax on stocks. So gold ETF is taxed the same as physical gold instead of as stocks or stock ETFs. Now talking about short-term capital gains tax, the short-term capital gains on gold ETF are treated the same as ordinary income. This means if you sell your gold ETF for a profit in less than 12 months from the date of purchase, then your gains will be considered short-term and will be taxed at the same rate as your ordinary income. Now the good news is if you incur a loss on your gold ETF investment, then you can apply that loss to reduce your annual taxable income up to $3,000. Now here is an interesting fact about one of the gold ETFs. If you are looking to convert your gold ETF investment into physical gold, or at least want to invest with the assurance that there is a possibility to convert your ETF into physical gold, then VanEck Merck Gold Trust with ticker symbol OUNZ allows you to convert your ETF holding into physical gold. The good news is converting your ETF to physical gold is a non-taxable event, which means if you convert your ETF into physical gold, it simply means you are taking the physical delivery of the gold that you already own. So you won't incur any taxes on getting the physical delivery of the gold. If you want to know the process on how to get the delivery of physical gold, then you can visit the website of VanEck Merck Gold Trust and check the complete process. That's all for this video, and I hope you found this video helpful. Let me know your thoughts in the comment section below.